Yeah, we'll get into the next subject, which is the equity investment, which from a level one standpoint constitutes around 10% of the total weightage, right? Whereas probably the level two occupies the highest weightage for this equity investments. Probably in level two, it goes even up to 20 to 30% kind of a weightage. So the level one focuses primarily on the conceptual aspects relating to the equity securities, equity markets, and some basic valuation mechanisms and very basics kind of stuff. Whereas in level two, it entirely deals with the valuation aspects itself. How do you value a equity security? So, from this standpoint, this subject has been allotted six different readings. And the first of it is understanding the market organization, equity markets. I mean, it's a complete financial market here. It's just not the equity, the entire financial markets. How are they organized and what is their structure? So, to start with, whenever we talk about a financial system of a country, right, in India also, if we see the typical financial system, every person or every company should be able to do these kind of activities very effectively. That is where we say the financial system of the country is efficient. People should be able to save their money, and corresponding to the saving, they should be able to get some kind of return. The people should be able to borrow the money at least quite comfortably from various sources, and companies should be able to raise equity capital for running their businesses. That is what we constitute the entire financial system of the country, where there is some kind of saving process, borrowing and lending process, investing in the form of equity capital, and people should be able to people are probably the lenders should be able to assess the risk of the various parties, and they should be able to do a proper risk management. And even the buying and selling, the transactions process should be very much efficient. So one party should be able to pay, which means the rupee or whatever is the currency, it should have some meaning associated with it. People, one person should be able to give some currency and he should get some kind of asset in exchange for that. So all these things, and that too, the information efficiency should very much be there, which means probably the news and, I mean, corresponding to the news, people buying more, selling more, such kind of transactional efficiency or informational efficiency is also very much important as a part of any financial system. So, if all these things are very effective in any particular country, we say that particular country's financial system is more and more efficient, right? Whenever people want to save, they should have avenues to save, and corresponding to that saving, they should be adequately compensated. Whenever people want to borrow, there should be some mechanisms, either banks or some other sources, so there should be a kind of balancing across. And for the bank, they should have another mechanism of investing that money, so it's a kind of a rotation process that should be there as a part of the system. On that entire thing is what constitutes the financial system of a country. And whenever we talk about efficiency associated with the financial system, we talk about all these things to be pretty much comfortable for each and every participant in the system. Now, if we see some of the typical markets, we can classify them under various criteria. Financial assets versus real assets. Most of the transactions, when I say financial assets, we have stock markets, we have bond markets, which are purely financials. We have a derivatives market, purely financial assets, which means they don't have a physical presence, purely accounts kind of transactions, right? Money from my account goes off, my demat account is credited. So it's purely from that standpoint. Whereas when I talk about a real asset based market, probably commodities or real estate, where are gold, I'm possessing something. Some assets are physical in nature, which I can buy and sell. There is a mechanism to buy and sell those kind of stuff, as well as financial assets like stocks, bonds, mutual funds. These are the various financial assets that are possible where the buying and selling of those things is possible. Then we are also talking about the markets, debt versus equity, where there is a lot of loans given versus equity investments done. So there are some companies which raise capital through loans, some companies which raise capital only through equities, some companies which do through both the mechanisms. But markets wise, see, once they raise the capital, those particular shares or bonds, they are traded on the capital markets like stock exchanges, or in these kind of avenues, they are tradable. So the securities wise, we can come across debt versus equity kind of securities. Some kind of securities are there which are exchange traded versus private, right? Probably real estate. We don't have any exchange for real estate transactions in India, right? It's purely between two parties. Whereas for stocks, there is an exchange. There is a Bombay Stock Exchange, or a National Stock Exchange, or any of these kind of exchanges that are present. So we have those kind of some securities are traded over the exchange, whereas some of them they are traded, they are private, and the transactions are merely between two parties. So even that kind of a classification we can see for the markets. Then, okay, derivatives we haven't touched upon still, but in the derivatives markets also we have the derivatives on financials. Like probably there are derivatives markets dealing with stocks, stock derivatives, stock futures, stock options, or probably index futures. These are all financials, like bond futures, or probably the interest rate futures, currency futures. These are all typically the non physical, which is more of a financial derivatives kind of market. Whereas we also have a physical derivatives market like gold futures, commodity futures, commodity options. These are all going into physical derivatives kind of market. So we have markets for those kind of securities. We can also classify as spot versus future delivery. Derivatives markets are all future delivery markets. Whereas spot is probably I'm buying and selling any. I can buy a currency today. I can buy commodity today. A lot of transactions can happen today, and if the same thing happens in future, we call it as the derivatives market. So the detail we'll look at it when we talk about the derivatives, but simple word for derivatives markets are typically the future delivery kind of markets are all classified under a derivatives kind of markets. Then we have a primary versus secondary market. All IPOs and all come under the primary market, whereas exchange traded kind of things, once the security is issued, the trading that happens on it happens in a secondary market. But the first time when a share or a bond is issued to the public, it comes under the primary market, where the direct interaction comes from the company to the public. Whereas after that, it is purely traded on the secondary market. So we have some primary markets, some on the secondary market. Then there is a classification on money market versus capital market. Money market is all trades which are maturing within less than 1 year, like treasury bills, commercial papers, certificate of deposits. We have seen in our working capital management chapter various kind of money market instruments that are available. So all these things versus capital markets is wherever the investments are typically for a longer term period, stocks, bonds, and all, they get classified under the capital market kind of securities. Then traditional investment markets versus the alternative investments. Traditional investments are generally the stocks and bonds, which are typically covered by CFA. Whereas alternate investments market, they are just touched upon by CFA, but not heavy depth into the alternate investments markets, whether it is real estate or commodities or hedge funds or mutual funds, right? These kind of things, they are just touched upon by CFA as I mean, in mutual fund you can very well create again a combinations of everything. I mean, they come again into the traditional market also as well as into the alternate itself. But all these real estates, right, or you can talk about all commodities, they all come under the alternate private equities. To some extent, they come under the traditional also, but they are slightly different from traditional, the way they operate. So they all come under as a part of the alternate investments kind of markets. So CFA just touch bases the concepts of all these, but not more in depth. Now, when we talk about different types of instruments, earlier we have talked about different types of markets. Now, when I look at various types of instruments that are available in different markets, we call them by different names. Securities is something which is more to do with financial assets. We call them as securities like bonds, equities. We call all of them like mutual funds, which are more of financial related stuff. We call all of them as securities. The very common word. See, for agricultural and physical things, we don't call them as securities. We call them as commodities. So security is something which is more to do with a financial asset kind of stuff. Either the fixed income securities like bonds and all, or equity securities like common stock or preferred stock kind of stuff, or it could be pooled vehicles like your mutual funds, hedge funds, any of the funds. They all come under the various securities for us. Then we use a name called contracts, especially for derivatives and insurance. All the derivative products like forwards, futures, swaps, and options, we call them as contracts. They are not securities. We call them as contracts because they are merely nothing but agreements. Agreements for buying and selling something in future at a price decided today. So they are merely contracts, and insurance is also more like a contract. So we don't call them as securities kind of word, we call them as contracts. Then we also have commodities. It could be agri commodities or industrial commodities or even precious metals. They are all different kinds of commodities. Agricultural, generally we have all these bajra, maize, corn kind of commodities all come under agricultural commodities. Then we have industrial commodities like iron and zinc, nickel kind of, which are heavily used as a part of industry. Then we also have precious metals like gold, silver, platinums kind of commodities, and even energy products like petrol or oil, natural gas. All these things come under the energy kind. All these commodities, they are traded either in the spot market or in the futures market also. Most of these commodities are traded even in the futures market also, and you can very well buy them in the spot market also. So both markets exist for almost all these commodities. Then the fourth set of instruments we always deal with is the currencies like dollar, pound kind of euros and all. Even for them, you can buy in the spot market or in the futures market. You go to any dealer, he'll give you dollars immediately for the rupee, that is the spot market. Or you can enter into a forex foreign exchange, and you can go for buying it after 1 month, but fixing the deal today itself. That's like a forward market kind of stuff. Then we have, in the entire financial system, we have some intermediaries also, like your brokers. Okay, there is a difference between the broker as well as agents in a lot of scenarios. When we say brokers, they are always uh, they are the connectors between the buyer and the seller. Generally, they represent the buyer. Right? When I say I'm a broking firm, you work on behalf of your customer. You place the trades on behalf of your customer. Right? Any broking firm, they try to connect. They are not the employees of the seller. See, that's the key difference between a broker and an agent always. Whenever we talk about an agent, the agent primarily represents the seller. In insurance companies, we use the word called agents because the agent's job is primarily to work on behalf of the seller. He works on behalf of the insurance company. Whereas when we say broker is an independent entity who will be a middleman between the buyer and the seller, and he will charge based on the he will charge a commission based on some amount. He may charge the buyer, or he may charge the seller, or he may charge both the parties. For different scenarios there could be different. Whereas if it is an exchange, we are talking about, it's a centralized location. Exchange is nothing but it's a physical location where buyers and sellers get together and execute their deals. Like BSC, there is an office for it. There is a physical location for BSC where buyers and sellers get in there and use various mechanisms to execute their trades. Whereas the difference is, see, for some markets we have only dealer driven. Dealer driven is the dealer is also an intermediary like a buyer, like a broker, but the dealer will match the orders at different points in time, whereas the broker will match the orders at the same point in time. Let's say uh, uh, we are talking about an ICICI Direct, who is a broking institution, right? Probably the seller order and buyer order are matched and a sale is executed. So the dealer is not, I mean, the broker is actually not getting into he buying it or he selling it. He is only connecting the two parties. Whereas when we say someone playing the role of a dealer, even for your physical commodities, we talk about people, right? I'm a Sony TV dealer. What is the typical name? What is the typical meaning that is coming out there? He sells from one. I mean, he buys from the seller. He sells it to the buyer, and these two could be at different points in time altogether. Those are what are called as dealers. Even if you typically see the forex market, it's a purely a dealer driven market. You go to